Welcome to a random talk down Quant Street. This series takes you behind the scenes of quant investing, breaking down complex ideas and tackling the questions you've been too nervous to ask. Matthias, welcome. I'm so glad I have you to ask these questions of.
Thanks for having me, Erica.
So Matthias, let's start at the very basics. What exactly are factors in quant investing? I know you feel like saying, well, how much time do we have? Because people devote whole careers to this concept.
Well, let's keep it simple. So factors are characteristics of the stock or the associated company that explain the risk-return profile of the stocks. So it can be classical examples are the size of a company, so its market capitalization, its evaluation, so something like the earnings to price ratio, or its momentum, so the stock price trend.
Okay, so you're describing that every stock has a certain characteristic. And if you as a quant in building your model can understand what these characteristics are over time, you can benefit by investing in those with a certain characteristic?
Exactly. And then you have maybe two groups of stocks. So you have the group of the expensive stocks and the group of the cheap stocks. And the return difference between these two, they tend to behave similar within the group. And the return difference between the two groups, this is the factor return.
Okay. And these factors, just describe how one even begins to discover these factors, because I know it's also rooted in academic research going back decades. Yeah.
So for the factor, we don't need only the strong empirical evidence, so that there's a long-term premium associated to the factor, but we also want that it's robust across regions, that it's robust across sectors, that it's independent of the other factors, so it adds top of the other factors, and it also has to cover transaction costs. Otherwise, it would be just a factor return on the paper, but not in the real world. And most important, we also need a clear economic motivation for that factor.
So there's quite a discipline around this. So given that discipline and the framework, and I assume this is an acceptable framework across the industry globally, how many factors are there then?
So we have on one side the so-called Faktorzoo. So there are more than 300 factors published in the academic literature. Yes. But when we try to replicate these 300 factors, we often find that they simply don't work. A lot of them. So we cannot replicate them in our database, or they are not robust across regions. They don't cover transaction costs, or they're just measuring the same thing in various ways. So they're not really distinct. So what we see is that like 5 groups of factors or signals, valuation, quality, momentum, analyst revisions, and low risk, they really explain differences in long-term returns. And on top of that, we see many rather signals that describe the short-term patterns in stock returns. And these are like signals that we combine in our trade timing model. And that is one that we see as an additional factor. And
is it your ambition in your career as a quant to be the one who discovers a new factor that indeed meets all these criteria of being stable, applicable across markets and time?
Yes, of course. And we have also the history at Robeco that we discovered factors that were also then replicated and used by others, like our residual momentum definition.
Is there a phenomenon perhaps of a factor that might have worked, say early in your career or 20 years ago, and then it no longer works, and then others that didn't work that are then rediscovered?
So what we see is that the signals behind measuring these broader factor groups, they tend to weaken a bit over time. Yeah, I don't say that they stop completely working. Sometimes you see it, but on average, they just become a bit less powerful.
So they fade.
Yeah, exactly. They fade. And therefore, it's important to really enhance existing factor definitions or coming up with new measures to identify and measure the economic idea so that you continuously innovate and counter these small decay in factor or signal returns.
That's a really important point you've raised now about how you measure a factor, because my definition might be quite different from your definition. So could you give an example of that?
Well, there's quite some consensus across the broad factor groups. But for instance, what we really, I think, are doing differently at Robeco is the way how to measure quality. So if you ask 5 analysts to give a definition of a high quality company, you probably get 6 different answers.
Exactly.
But what we see is a bit that the details matter. Yeah? A lot of people look, for instance, at the top line, so the revenues, or the bottom line, the earnings of a company. But we really think and are convinced that between these two numbers, there's really the true economic profitability and strength of a company. And if you really can identify that, you have also a signal that not only describes strong company now, but also that explains future earnings of the company and therefore gives you the premium.
Matthias, thank you. Really insightful. We're pressing pause on factors for now, but in our next episode, we'll be talking about these factors in more detail with Matthias, and we'll be asking what the perfect stock looks like from a quant perspective. Do tune in again for that and do share the series.